Kev, it's
Your
time for
favorite?
this week in
Yeah,
trading history.
your favorite time, Patrick.
Oh, it is. And
It's like
this.
you got a business degree or whatever, but you really should have got a history degree.
Oh, come on. That's too much work. That's too much work.
As opposed to the business degree, which is really easy.
that was easy. Come on, it's just about looking at little squiggles going up and down, right?
That's right. Okay,
Anyway,
what do you got in? What do you got in
this
store
week in
for us
trading
today?
history? Okay, so I want to go back to May 21st of 1720, basically 300 years ago, back to England for the South Sea Bubble. And so on this day of May 21st of 1720 in the newspaper, the Daily Post, was featured an ad for initial public offering during the South Sea Bubble that was basically it was a hot period. Basically, think of the .coms or like the ICO craze during the cryptos, where a lot of these bubble stocks were super hot because one stock was running super hot and making pile of money. And so the point is that a lot of these questionable companies came into onto the market, and so there was about 190 companies during that period that were issued into the mania, but no one exemplified the craze better than this company, which was featured in that ad, which was offering a proposal to raise a sum of like 6 million sterling, which back in 1720 would be like hundreds of millions of dollars. And the best part is, it goes, and the best part of this is that the company advertised itself in the newspaper as a company for carrying out an undertaking of great advantage, but nobody to know what it is.
Nice. It was like a
So,
SPAC, special purpose acquisition vehicle.
yeah,
Like it was a SPAC.
we promise you we're going to raise money for undertaking that will be of great advantage to you, but we can't tell you what it is. But so I wanted to circle back to the South Sea Bubble and really just go through a little history lesson of it. And it goes back to 10 years earlier to 1710 when Robert Harley, which was the Chancellor of the Exchequer in London and in England, and the government at that time was running out of money. He gets this job, and the government is pretty much insolvent, and so they're trying to figure out how to deal with all this debt. They're pretty much at war with everybody, and the government was divided. They couldn't get any legislation through to raise taxes. He couldn't turn to the Bank of England. By the way, back then the Bank of England existed. It was one of the first central banks in the world, pioneering central banking. And shockingly, you can't connect the Rothschilds to this because Mayer Rothschild wasn't even born at this time. It was actually
The colonel with his little beady eyes.
yeah, there you go. But it was before the Rothschilds, even when central banking was being pioneered in London, England. But anyway, so he couldn't turn because the opposition party controlled the Bank of England because all their buddies were in there, and they couldn't go outside to global creditors because that wasn't an option because at the time England was pretty much at war with everybody. And so he had to figure out how to deal with this debt. So he turned to one of his buddies, this John Blunt guy, who ran this company, his Hollow Sword Blade Company or something. And they came up with a scheme. And to make a long story short, because this could be a 30-minute segment if we made the long version, but the scheme was the idea of refinancing the government debt by creating the South Sea Trading Company. And we'll talk about where the inspiration came, because it came from John Law and the Mississippi Company down in France, which was running about the same time. And so it was inspired by the South Sea Trading Company, which the government was going to give an exclusive charter to trade with the Americas, primarily the South American ports. And the funny part of it is that, of course, the company was never able to make any revenue or even turn a profit or anything in the endeavors. But that's actually not the cool part of the story. So what the scheme was essentially they would make a lucrative offer to the bondholders of the government debt to trade in their government debt in return for the shares, like a swap.
A debt for equity swap.
A debt for equity swap, right?
Nice.
And so they make this company. And they legitimize this. They legitimize this because eventually they put King George the First as the governor of the company. So you have the actual.
Wait, is he the guy who killed all his wives?
Oh, I don't know. I don't think so.
I know we're not English. Like we don't know these things.
But,
like,
but I mean that's a legitimate thing. You've got the king himself, actually the head of this South Sea Company, right? And this John Blunt made sufficiently large enough. Got a sufficient amount of the politicians on board with bribes with these lucrative share deals where he had no problem getting this passed through the government. The deal basically had all these MPs being able to buy stock of the company but not have to pay for it until they sold. So basically, they were getting free access to the company, and this was great for John because he basically had to pay no cash for the bribes, but gave huge incentives for the politicians to keep seeing the stock rise.
Right.
Right. So you see where this is going. We're taking the entire national debt of England and converting it to equity.
Nice.
Right. That's
nice.
the starting point. That's the starting point of this
Right.
bubble. So now the government would allow the South Sea Trading Company to issue an amount of stock equal to its debt. But the catch was that it was calculated on whatever the share price was at the time the law was passed. But the moment that this started happening, the stock started to rise, and this gave the opportunity for them to exchange fewer and fewer of the shares for all these bonds, leaving huge amounts of the shares for profit in the company for Blunt and his buddies and the company revenues. And so the company never got going successfully as an actual profit and revenue generating enterprise. The only source of revenue for the company was the share price rising, which they had all the excess shares of.
Nice. That's always a great. That's always a great source
great
of
business
revenue,
model.
Though, right?
So,
Yeah.
so like a proper Ponzi scheme, the entire plan hinged on the stock continuously rising. So each time the stock started to dip, Blunt needed to come up with a new wave to prop the stock higher. And so one of his mechanisms that he came up with, he devised a financing plan to buy the shares directly, to let individuals buy the shares directly from the company with a 20% down payment and not have to come up with any further payments for 2 months. And they can start making installments at that point. And so
Nice.
think of it.
I didn't realize that. So he was the first kind of innovator of the receipt trade.
Right. Right,
Yeah.
and so what happened here was that it's like the modern day kind of real estate flipping. Like in Canada, what during the real estate craze, everyone would go and put a $20,000-$30,000 down payment on a new home that doesn't close for a year, in the hope that the real estate market rises over the next year, so they can flip it before they actually have to really buy it.
Well,
right?
of course, 'cause
And-
don't you know Canadian real estate always goes up, Patrick?
It always goes up. That's a
Yeah.
safe trade. Now, so this allowed huge leveraging up. There were these people that were essentially leveraging up 5 times the amount and flipping it basically 2 months later, never having to come up with the money to actually buy the share or make any installments. And
It sounds exactly like Toronto real estate.
It does, doesn't it? and we got to include Sydney in that. Sydney real
correct.
estate as
Yeah,
well. And nonetheless, several months later, the price started to dip again. So he came up with an even new plan. And so he started to actually issue the South Sea Company itself. So from all this money that they were collecting from doing this, they were offering loans of up to £3,000 to people to buy their own shares. So, so they were basically. So this was today's version of share buybacks, but they were having the public do it. Now today, companies are far more refined and more kosher, and they do this financial engineering by just buying their own stock back with their own money.
And nowadays, people are much more sophisticated. They get on Twitter and talk about $420 buyouts.
So now, Kev, of course, when you have this much froth about one company making this much money, rising, and all of this, this led to the first IPO craze of our time. And so what happened was that because the appetite for easy money and all these profit-hungry investors were there, of course, everybody comes rushing out to want to take a company public, to take advantage of all of these speculators that are frothed up. It reminds me so much of the ICO craze that happened last year, right? And so you have a scenario where about 190 of these companies came out and issued these IPOs. And one of them, of course, was the company we referenced at the start of the session. But what's amazing is literally only like a year later, like only 4 of the 190 companies that went public were still around. The rest all basically were either fraudulent ventures or were just vaporized in the bubble burst afterwards. Isn't that crazy?
It sounds just like the ICO craze.
Oh, and the .com craze too, right? Like the pets.com, and like it's amazing how this shit repeats itself over and over again, right?
Yeah, it's
and
funny.
So,
like that's the 1700s. Like that's
yeah.
Yeah, it's like 300 plus years ago that this happened.
Yeah, no, it's crazy. And so, like all bubbles, the Ponzi and Ponzi schemes, for that fact, like, so if we're talking Bernie Madoff or anything, it becomes a victim of its own success, which is that when the size grows so big, it simply collapses under its own weight, right? Like it's just, there's a point where it can't sustain itself anymore. So I thought it was really interesting to kind of think about the size of it. Now, when I showed this chart last week when we talked about Standard Oil, but South Sea Company makes it as the third largest company from a bubble perspective. It was about on an inflation-adjusted $4.3 trillion at the time. But what was amazing about it is actually putting the size of the company relative to the size of the British economy. So what you want to think is that the company was at some point worth, from a capitalization. So remember, there was about like 30 million pounds of government debt that was converted into equity. And that increased tenfold. So the market capitalization of this company was like 300 million pounds. But if you translated it to the size of the British economy, it would be the equivalent in the U.S. today of having a company that had a market capitalization of $85 trillion.
85 trillion?
Yes. Like,
now that's funny.
So what you want to think is that genuinely and rightfully so, Blunt was concerned that there was not enough money in the country to support the stock price.
That's always a problem when
that's always a problem, right? And so this thing is this gargantuan beast, right? It's just it literally is the entire British. Imagine Trump saying our solution is to take the $20 trillion of federal debt and we'll just turn it into equity. We'll give it some nice spin and we'll
make a Trump ICO. That's what he should do, man.
Yeah, just convert all the
a Trump ICO on the blockchain, because that's great shit. Like that blockchain stuff is awesome.
This is crazy. So anyway, so the crazy part is the company never made a cent selling goods from the South Sea. It burned through almost all of its cash. And at the end, what was crazy was it was the proverbial smart money, dumb money pivot, which is that right at the top, they did an offering at £1,000 a share. And they made an offer to the public that you only had to put 10% down with no payments for a year. Okay. It's like a ninja loan. It's like a ninja loan, dude.
No, it's like a receipt, like unbelievable receipt, like it's crazy. And,
yeah.
But like the thing is, it wasn't an option. You had to put the 10%. You had to pay the rest 90% in a year's time.
so on the chart we're showing here on the thing, you can see that chart on the middle there where it went parabolic. It literally hit 1,000. That literally marked the top of the stock rise, and
Wow.
rightfully so. Just the way you've shared many times on the show, like sometimes at the end of a bubble, the greatest parabolic rise is right at the end, and so it rose from like 100 to like 500 in a span of like a year, and then it was just in weeks that it went from 500 to 1,000, right?
Wow.
Like there
That's
was
just
that
unbelievable. That's a great chart, man.
It's crazy,
Yeah.
and but what's amazing is that because the smart money knew how crazy this was, a lot of the really people that got in early started dumping the stock into that offering, and then he tried to prop it up again by offering it. Get this, he made a desperate attempt to prop up the stock by announcing a 30% dividend a year.
It's a shit show, man. Like it's just unbelievable.
And if there's any way that you can for certain make everyone know that it's a Ponzi scheme, is to realize the capitalization of the company and saying, where the hell are they going to come up with 30%?
Hey, listen, I
cash
just
flow?
realized as you told this terrific story, I realized that Elon's got an answer to his problems.
What is that?
A 30% dividend.
He should, yeah, for sure. Tesla should announce a 30%
Or
dividend. That
better, or better, you know what? What about 10% down on a stock purchase?
yeah.
That's awesome. You know what I like best about this chart is the fact that it never ticked at $1,000.
Actually, I think it did because
I don't know. It doesn't look like it.
It doesn't look on the chart, but it was offered at that, so there were definitely people buying it on that.
Yeah, but don't
offering.
forget the people were buying it, but they only had to put down 10%. So I'm betting that that's right, and it never ticked at $1,000, Patrick.
Maybe
because those people would buy it.
You know, I even though you're old, I know you weren't around back then.
Yeah,
and
that's even a little old for me. You know what? Yoda was around, but I wasn't. But that is a terrific story. Now,
okay,
listen,
wait. There's one last
sorry.
thing. Okay, no, go. You have a quick point.
I have a quick point. I see this great historic heavyweights chart. So far, we've got the Dutch East India Company. Now we have South Street.
South
Street. That's a burger place in Toronto, for those who don't know. You know what? We taped this on Friday night before dinner, and I'm hungry. But I see that there's now Mississippi and then Mississippi Company, which I'm looking forward to. And it's unfortunate we couldn't do that one today.
That's John Law. We're gonna still do that one.
Yeah. But then what's amazing is Saudi Aramco's up there.
Yeah.
I had no idea it was that big.
Yeah.
Did you?
That was in 2010, though. That was.
I know, but did you know it was that big? Like
I heard it was $2 trillion at its recently, not 4. I mean, but that was a decade ago, so I don't know what the circumstances were for it being that big. But that's got to be a story we talk about at some point.
For sure,
right?
that's going to go into the market history segment.
So I need to leave it at this: Sir Isaac Newton, Newton's law. The great physicist and mathematician got caught up in the South Sea bubble.
Really?
And so yes, he did.
I didn't
and
know
so he was coined for saying that he could not calculate the madness of people.
Oh, that's right. I know this story. He says I can figure out the trajectory of
movement of stars, but I can't.
Right.
But not the madness of men.
Yeah.
And so he lost 22,000 pounds,
which was back when 22,000 pounds was a lot, and not just a night
out. Yeah, no. That was the equivalent of like $3 million today, or some crazy amount.
Really?
And so, absolutely, it was crazy. And so, but what was the best was that he first got in the early stage and flipped it for 100% return, making like 7,000 pounds. And so he made himself a millionaire at the time. And then the temptation swept him up, and the enthusiasm to go back in. It's the famous chase scenario. And so he goes. It's like you having bought Bitcoin at like 100 and then
no.
Bought Bitcoin. You never got back in.
I mined Bitcoin at 100. But there's lots of Bitcoin fans. There's lots of Bitcoin fans that you're right. made all sorts of money on the way up, and now are getting schmucked buying it again.
But no, but they bought, then they sold, then they realized it was kept going higher, and then bought back in at an even higher price, and then got smoked.
That's
What
right.
happened.
You're right.
That's what happened to. That's the story I was trying to imply. Not that happened to you with Bitcoin, but I was just trying to create a story to relate to. But basically, one of the smartest men to ever fucking live, basically was pretty much bankrupted by the South Sea bubble, and for the rest of his life he forbade anyone to speak the word South Sea in his presence.
Nice. That's gonna be like me with JGB and Boons.
Never shall we speak of them in your presence again.
Anyways, Patrick,
Anyway.
that was a terrific
Yeah.
story. Thank you so much, buddy. That was awesome.